keep talking some ETFs. So joining me, Cinthia Murphy, is investment strategist. And you've been on my beat for ETFs for a while. At TMX VettaFi, by the way. We've been talking about finance, ETFs. You've got a journalist background, which is why I think we've always kind of clicked on the subject matter. What's interesting to you? Because it feels like every time I do something for ETFs, it like blows up.
Yeah, it's been, I've been in ETS since 2009. I was just thinking about that. It feels like forever. And what's amazing about this space is, as you know, it's been not only disrupting other investment vehicles, primarily mutual funds, but also with all the options-based growth, the derivatives use annuities and structured products. All of these types of products are kind of finding their path into the ETF wrapper, which has been fascinating. So the product innovation is constant. The amount of asset managers stepping in is growing constantly. So, the puck is always moving, and so it keeps us busy for sure.
There is an interesting filing actually today about dimensional and the class share kind of market structure shift, which is I don't really understand this, to be honest. Like, I didn't even really get this until somebody called me today and said, "Hey, are you watching this?" And I'm like, "What should I know about this?" Because it seems like I already kind of had this framework where mutual funds were just all kind of dying out, But I guess there is kind of still a need to have some kind of, I don't know, hybrid vehicle or something.
Yeah, it's really not hybrid. I think a way to think of it is one strategy in two different wrappers. So it's a way for, I think, a lot of mutual funds, as you've been watching, a lot of outflows, persistent outflows over the years. And so a lot of these managers are trying to figure out, how do I get into the ETF space? Obviously, I need to be in the ETF space. That's where all the growth is. So things like 351 exchanges, mutual fund conversions to ETFs, all of these have been in the process. And
it
now
doesn't matter for the end user, right?
Well, it's a choice. It's a product choice. So it really is more now. You can open the floodgates to a lot of mutual funds out there can just implement an ETF share class of that existing strategy. So the good thing for the ETF space is that this would be a brand new ETF that comes with a long track record of the existing mutual fund, because they carry that track record. But they get to be implemented typically at a lower fee. They get to be intraday traded. They get to be transparent. So it's kind of like a path, I think, for the asset managers to expand their offering and reach this audience that can't get enough ETFs.
Beautiful. That's why I love it. That's the journalist-specific take that I needed. So especially when I think about from the customer side, because I was thinking, all right, a fund shows up, available to buy. Who cares what the process it went through? But to your point, because it'll have the back data from the existing mutual fund, that actually is a nice kind of little bonus there where it's not starting from scratch.
Yeah, absolutely. Because we know if you look at the advisory channel, a lot of them still use that 3-year live track record as a metric before they consider entering in a strategy. All these mutual fund legacy metrics to adoption, they still hold water in the ETF world. So now you have a brand new ETF that already has this long track record.
Yeah.
So the good news is there'll be way more product choice. The bad news is there will be way more product choice.
Exactly. Because there's already more ETFs than stocks.
So, I love to quote this number. Dave Abner from Northern Trust back earlier this year, estimated that we'll go from 4,000 ETFs to 7,000 ETFs like that once the share class approval comes. So if you're an advisor then you got to do this due diligence. I mean, your job just got much harder.
Wow.
So we're all curious. We're all curious to see how the adoption actually happens. And just because a mutual fund exists becomes an ETF doesn't mean it's a good product. There's a lot of bad mutual funds out there that just having an ETF share class doesn't mean the strategy is viable.
And that's where, too,
so
I would say that, like,
noise.
Yeah, there's definitely going to be a lot of managers who now say, hey, we're an ETF. But, like, okay, do you cost the cost of a standard ETF, or are you still carrying a mutual fund cost?
Yeah, exactly. So, and from what we understand, from when we talk to the asset managers out there, comes the approval, great, let's go, great. The industry is not ready for it. So, there's a lot of conversation about the actual operational plumbing to make this happen is nowhere in place.
Okay.
So I don't think it's going to be an overnight thing where the funds just multiply. I think now that with the approval, these firms are going to start figuring out how to actually make that happen, how the custody looks like, how the trading looks like, because these mutual fund shops don't have all the infrastructure to manage daily trading of an ETF. So all of that's still going to happen. So it's going to be a slow.
It's a great point. They're coming. It may not be overnight, but that number is going to get big.
Yep.
The number's already big. Do you see it as kind of a fun novelty that there's more ETFs than stocks now, or is that just kind of like, hey, business as usual? This is the investment world. Like, we're going to make products, you know?
Yeah, I think it's a testament to the viability of the structure. It has yet to be disrupted with something better. It has broadened access. I'm always impressed that there's still first of a kind products. There's still innovation. But I know versus the number of stocks, I think we like milestones. So it's just more of a conversation point than meaningful statistic.
There were more mutual funds than
Yeah.
stocks. Okay, so let's talk about some of the shorter term stuff as we come up on the last quarter of the year here. Because there's so much money in ETFs, what are we watching in terms of rollover, turnover, rebalancings, or just where the flows are going, basically?
So today is the last day of the third quarter. So unfortunately, we don't have the final quarter numbers, but I was pulling up data this morning. And what we can tell from the third quarter is ETF demand has actually picked up pace in third quarter versus previous quarter. So almost $400 billion in assets just this quarter, which is massive. Year to date, we're already over 900 billion. So we're probably going to cross last year's record. So the story is great year for ETFs, lots of assets going to ETFs. They continue to be the vehicle people are using to navigate uncertainty and all of that that we know.
What's the hot kind of theme? Is it still very tech oriented? Are the flows following the price, which has generally been led by that group?
So I think there's a few broader trends that I've been watching over here that have been very persistent. So one is, surprisingly, appetite for your low-cost beta.
Okay.
So a fund like Vanguard's VOO, S&P 500 fund, super cheap, like tons of assets, another $83 billion.
Well, it keeps working.
Crazy.
Keeps going up.
But also in that category, like SPLG, which is the Spider low-cost S&P 500 ETF, 3 basis points for that portfolio. That is like top 5 asset gatherer this year. It's been consistent.
Quick way to get to the top is to be the cheapest.
Exactly, but it's not the trading vehicle favor. It's not SPY. It's not some of these popular trading options. Same thing with QQQM versus QQQ. QQQ not as strong in asset gathering. QQQM, which is the cheaper QQQ, tons of assets. So I think it's been really interesting to see like the appetite for your low cost beta building block, whether that's advisor, whether that's
building
retail,
block, that's a good term,
just going there. It's been
one.
really interesting to see that demand, and that has been persistent. Every quarter continues. Another big theme this year has been the year of the diversification. So if you look at if you take equity and fixed income out and you put everything else in kind of the other bucket, alts,
gold,
commodities, crypto, all of that.
What about the hedged equity stuff?
Yeah.
Alternatives, right? Options based in that category?
All of that has taken over 10% of all asset flows this year. But if you look at their asset footprint, it's about 3.5%.
Are buffers in that category?
Buffers are in the active. So you take that out.
Okay.
So alternatives is a big broad category, have taken in 3 times their asset footprint this year. It's been a big year for the diversification.
Okay.
Gold looms large there, precious metals, crypto, huge, as you know. Lots of managed futures ETFs taking in assets. So it's been a big year for that appetite for diversification, and that has also been persistent and continuing this year.
SPY is going to get a little bit more love here, or your low cost too. They're screaming because the market's ripping. Okay, so it's interesting that you mentioned the buffers in the active category, because that was the first buffer I've kind of thought about as being active, the one we just talked about with innovative ETFs, because they've got that asymmetry where you actually get your biggest outcome if the market goes down.
Well, the trick of the active category today is that is now what we think of traditional active, that stock picking, discretionary, unconstrained strategy. Really is a lot of it is like it has an options overlay. It falls into that active category. So active is taking over almost 40% of flows this year, huge category. And derivative income, biggest asset gatherer as a category, and defined outcome.
Chicago.
Yes.
Okay, so tell me that again. I love when my priors get validated. Is there any better feeling? Okay, so options-driven income is the fastest in what category?
Active. Within active, this year is taking about 15% of all flows. It's gone into active, going derivative income. So it's picked up more assets than the ultra-short bond category, large cap blend category.
15% of all flows in the active category?
Yes.
is options income.
It's been options income. So it's been a huge
Yeah.
appetite. And then defined outcome category also growing dramatically. So again,
Right,
it
which is
speaks
the
to
buffers.
that diversification, that protection. A lot of how do you minimize downside losses has been a big thing this year.
Yeah.
So
By the way, do you find
outcome-
that ironic as I do? The market keeps going up, and like some of the most popular things are about hedging downside. Like the irony here.
It's ironic, but it's also reassuring. Like
Sure, yeah.
we're not just going crazy and just buying the leaders because
And people buying the building blocks.
And earlier this year, we learned the leaders turn laggards quickly, like the Mag 7. And then, okay, they turned it around, but you can be on the wrong side of that trade very quickly. So I'm loving the discipline of worrying about downside losses. So
all right, fair enough.
I think it speaks to the health of the investor mindset today.
The F1 drivers in Germany, traders, those guys had differing thoughts. They were all about hitting the gas, then hitting the brake, but that's kind of their style. So great stuff, Cinthia. Great perspective as always. Appreciate